ignoring an underwhelming earnings report from a stock that is 10% of the NASDAQ index. So there's concentration risk within Nvidia, there's concentration risk in the index. When is the market going to care, Clint? When?
You know what? I mean, we'll see if this is the beginning of the end, so to speak, for Nvidia's run. But I think here's what a lot of investors miss is that when you're looking at the performance, the quarter to quarter financial performance in these high growth stocks, especially, it is the rate of change that matters a lot. Investors want to see, especially institutional investors, there's a quant factor called analyst revisions. And it performs very well. It's very well aligned with momentum. And it says that stocks that are seeing positive analyst revisions go on to outperform. And so you want to see analysts, raising growth estimates for the next quarter, for the out year, and so on. What you don't want to see with these high growth stocks is that rate of change and their fundamentals start to slow down. So like Nvidia can come out and they can hit it out of the park, and they can come out and say we had 50% revenue growth in the most recent quarter. But if that's starting to slow, that could call into question, is it worth paying 40 times next year's earnings to buy a stock who's starting to see a slowing revenue growth rate? And so there's a couple of numbers in their earnings report that stood out to me. One is, look, yeah, they beat on the top line, they beat on the bottom line. I saw somewhere that this is the 9th straight quarter that they've had 50% year over year revenue growth. But of those 9 quarters, this is the slowest one. So again, you're looking at the number and you're like, wow, 50% growth for the 9th straight quarter, that's really good. But if that number is going to start comping against more difficult numbers, like if they've been doing this now for 2 years in a row, that number, that growth rate is going to be going against a harder and harder number each coming quarter. And again, in my opinion, to justify paying 40 times next year's earnings for this stock, they can't afford to see that growth rate start to trail off. And so if you start to see any kind of cracks in the underlying AI spend, here's another crazy stat I saw. Half of all AI capital spend makes its way to Nvidia, and so everyone, rightly so, is fixated on their data center unit where you see most of that show up. And that was another thing to keep an eye on. Data center is a very, very slight miss, but data center revenues came in just a little bit below estimates for the quarter.